Hello, everyone. In continuation to our strategic management introduction, this is part 4. In this, we start with the Association of Change Management Professional. This association had given how can you proceed with the process of the change management. They give us step-by-step ideas. So this standard includes a definition of practices, processes, tasks, and activities for change management. The steps recommended by them are: first one, evaluate change impact and readiness. Means first we need to assess the organizational's readiness for the change. Then second, in that you need to identify the stakeholders and what are their interests. Analyze the change impact on business processes, technology, and culture. Then finally, determine change complexity and also the risk involved in it. Second step, formulate your strategy. Means you have to define your objectives and scope of the change what you're expecting. Then develop a change vision and mission. Then identify the key stakeholders and their roles. Then finally, determine communication and engagement approaches. Third step, develop change management plans. So in this, you will have to create a detailed change management plan. Accordingly, develop training and development programs. Then establish metrics and also how do you monitor that. Identify and mitigate risks. So these are all to be done in the third step. Fourth step, executing change management plan. So we need to implement whatever change management activities which are there. We need to implement those. Then keep communicating the change to your stakeholders. Provide training and support. Then monitor the progress and adjust the plans accordingly. Then the fifth step, closing the change management effort. Evaluate change effectiveness. Then also document all the lessons, whatever you had learned. Whatever successes you achieve, let it be small success, you need to celebrate those, which will motivate the complete team. Transition to business as usual. So in the whole change management process, you need to ensure employee involvement during the process. These are all the steps suggested by the Association of Change Management Professional. So we already spoke about this. Objective should be SMART. So here S stands for the specific, M stands for measurable, and A stands for achievable or attainable. R stands for the relevance, or it should be relevant to the thing whatever we are measuring. And it should be time-based. So that type of objective we need to create. So for all our goals, we need to have a FAST framework. Means F stands for frequently discussed, A stands for ambitious, S stands for specific, and T stands for transparent. So such type of FAST framework we should have for our goals. Then we are going to address about balanced scorecard. So it is basically a strategic management framework, strategic performance management framework, which actually helps the organizations to translate their vision and strategy into a set of balanced performance measures. So these measures are categorized into different perspectives: financial, customer, internal business processes, learning and growth. So here in balanced scorecard, we have two types of objectives: financial and also strategic. Means you try to keep a balance between both. So when you come to financial objectives, it relates to the financial performance targets. Maybe it is related to revenue or earnings per share or profit or increased shareholder value or generation of cash flows. For example, you may have a measure as increase in revenue, for which you might have kept that a target like achieve a 10% increase in the revenue compared to the previous year. That can be one metric from financial aspect. Another can be cost reduction. Then you may have a target saying that we need to decrease the operating expenses by 5% to improve the profitability. You may also have another measure called return on investment, ROI, where you may keep a target as achieve a 15% ROI on any new initiatives like that. Strategic objectives may be related to strengthening your market standing, competitive position, future business prospects like winning a market share, technological capabilities, lower costs, all in comparison with competitors. So it can be anything related to this. For example, I may keep a target that market share as my measure, for which I will say increase the market share by 2% in the target market segment. And I may also keep something related to production efficiency, improve production efficiency by reducing cycle time by 10%. Something related to that, or I can have a measure as process improvement initiatives implemented. Then I may keep a target that implement at least 3 process improvement initiatives to streamline our operations. So these are some of the objectives. Then balanced scorecard model requires evaluation from 4 different perspectives. One is financial perspective. We saw that in detailed way, what type of measures we can have, etc. Customer's perspective. In this, we may keep a measure. One of the measure can be customer satisfaction score. Then we may keep a target saying that achieve a customer satisfaction score of 90% or higher based on surveys. Means survey will be our methodology, and we want to have a customer score of 90%. Then internal business perspective, we can have something like a quality control related measure, like achieve a defect rate of less than 1% in product manufacturing. Then learning and growth perspective, something like keeping a measure of employee training hours. Then in that we may say provide at least 40 hours of training per employee annually to enhance the employee skills and knowledge. Or we can keep a employee engagement measure wherein you may keep a target as increase the employment engagement score by 10% through some initiatives like regular feedback sessions and recognition programs, etc. We may also consider another measure as innovation rate, introduced at least 2 new innovative products or services within 1 year's time. So these are all some of the measures which we can think about having as far as learning and growth perspective is concerned. Another important measure is this EVA, which is economic value added. It is basically a financial performance metric which measures the value of a company generates in excess of its cost of capital. So it is a widely used measure of economic profit, and it is calculated as net operating profit after tax minus, that is NOPAT, minus cost of capital. So cost of capital can be calculated as capital employed multiplied by the weighted average cost of capital. So for example, we can consider a company having the following data available about their financial information. Net operating profit after taxes, that is NOPAT, may be $5 lakh, and then total capital employed, that is the invested capital, may be $20 lakhs. Cost of capital, which is our WACC, may be 10.05%. Then we can directly calculate EVA, like subtracting, first multiplying the weighted average cost of capital, that is 10.05% into the total capital employed, which is given in this as 20 lakhs. Then subtracting that from your NOPAT. So you may arrive at an economic value addition added as $299,000.